Last year, I called VDIV the best dividend growth ETF on the market, and the returns have been absolutely massive. But my updated 2026 valuation model just flashed a massive red flag. Welcome back everyone, I'm Linus, aka the Swedish dividend investor. So last year I called VanEck Morningstar Developed Markets Dividend Leaders ETF, ticker VDIV or TDIV, the best dividend growth ETF. It is a favorite among dividend investors. It has a really strong total return, a decent yield and some decent dividend growth. But I want to take a look at how it's holding up in 2026. We will take a look at the following: what the ETF is all about, size, fees, withholding tax and current yield, holdings, sectors and country allocation. We will do a performance check. We will also check the dividend history overview. We will do a dividend and yield on cost projection, and we will do a new valuation and compare it to the 2025 valuation. As always, this is not financial advice. I'm just sharing my investing journey, my experiences and my own analysis. Read the full disclaimer in the description. With that out of the way, let's use some info provided by justetf.com, a great tool for researching ETFs. For those who have missed this one, the VanEck Morningstar Developed Markets Dividend Leaders ETF seeks to track the Morningstar Developed Markets Large Cap Dividend Leaders Screened Select Index. The index tracks the performance of companies that display consistency and sustainability in dividend payment patterns and is composed of the top yielding securities which satisfy the screening criteria. Only stocks from developed countries are included in the index. The stocks included are filtered according to ESG criteria. The fund size is 8 billion euros. The total expense ratio is 0.38%. And this fund is domiciled in the Netherlands, so there will be a withholding tax. Always take that into account. Their distributions are in euros, and their trailing 12-month dividends amounts to 1.65 euros. With a current price of 52.20 euros, we land at a current yield of 3.16%. They have distributions in March, June, September and December. Let's take a look at the fund structure. Before going through the holdings, sectors and countries, let's head on over to VanEck's webpage and take a look at how the underlying index work. So, to be included, the shares must have paid a dividend the past 12 months. The trailing 12-month dividend per share is not lower than 5 years ago. Dividend payout ratio of less than 75%. The index selects the 100 stocks with the highest dividend yield, and they weight them based on the total dividend paid. Maximum weight at the time of the review is 5%, and they have a maximum sector weight of 40%. The index is reconstituted and rebalanced semi-annually in June and December. And for those who are interested in ESG, can just pause the video. One thing I like about their site is they actually have price to earnings ratio and price to book value, 14.94 and 1.87. Sweet. For the following segment, just pause if I go a bit too fast. For their holdings, they hold 100 companies, and the top 10 is the following as of the 22nd of June. Verizon, HSBC Holdings, Nestlé, Pfizer, PepsiCo, Shell, Total Energies, Allianz, Novo Nordisk and Intensa São Paulo. Country allocation: USA at 23.2%, UK at 10.8%, France at 9.8%, Switzerland, Canada, Germany, Japan, Australia and other or cash. Not too bad and not too much in the US. Sector allocation: financials at 31.6%, energy 19.3%, healthcare 10.9%, consumer staples, communication services, utilities, consumer discretionary, industrials, materials, and tech. Let's do a performance check. We will do year to date, 1, 3, 5 years and max time frame, starting in September 2019. I've put them against two other dividend growth ETFs I looked at last year. FEUI, Fidelity Europe Quality Income ETF and SPYW, SPDR Euro Dividend Aristocrats ETF. And let's compare it to the S&P 500 as well. Year to date, S&P 500 at 12.64%, FEUI at 11.19%, VDIV at 11.13%, and SPYW at 7.49%. 1 year, VDIV at 28.89%, S&P 27.25%, FEUI 21.91%, and SPYW at 12.64%. 3 year, VDIV 76.55%, S&P 69.18%, FEUI 52.66%, and SPYW 52.16%. 5 year, VDIV 126.41%, S&P 94%, SPYW 50.52%, FEUI at 47.9%. Max time frame September 2019, S&P 163.25%, VDIV 153.35%, FEUI 83.06%, and SPYW at 59.89%. So yeah, VDIV has done a splendid job. I think the main reason they performed so well against the S&P is because they did so great and overperformed during 2022, something I went through in my first video about them. So hats off to VDIV, still a beast. Let's check the dividends. I've noticed only 40% of you guys watching are subscribed, so if you enjoy these types of breakdowns, make sure to subscribe, hit the bell, leave a like and comment. Thanks! Checking my spreadsheet for VDIV, we can see their dividends are trending up, with some minor hiccups along the way. They had a cut of 19.38% in 2020, but almost recovered the dividend in 2021. I've also written down their dividends until June for this and last year, and we can see they are a bit behind this year. But they were behind in September last year and still managed to succeed their 2024 dividend. The yield is calculated using last year's dividends, and it is sitting at 3.3% at the current price. Their 3-year CAGR is 3.31%, 5-year 10.59%, and the 8-year CAGR is 4.07%. I think the 5-year is a bit skewed by the 2020 lower dividend. So anyway, I thought we could do a yield on cost projection based on these numbers. This is for a lump sum investment, and if we just hold and don't reinvest. Starting with the 3-year CAGR, 3.3%, we have a yield on cost at year 10 of 4.72%. This is pre-tax, by the way. 5-year, let's say they knock it out of the park. 10% growth, yield on cost of 9.42%. 8-year, 4.1% gets us a yield on cost of 5.13%. So let's do the valuation. Why do we do a valuation? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of returns we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward, and a terminal multiple. This is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return, and it is used to discount the sum value back to today, and we get a present value. The present value is what we would need to pay to meet our required return. If the asset is trading above the present value, it is overvalued, and the other way around. We use 3 scenarios: normal, best, and worst case. Finally, we will do a mixed valuation to get a fair price between all the scenarios. I've gone for a discount rate of 10% for all the cases. I am using the 2025 dividend for the calculations, and for the normal case, I've gone with a growth of 5% for 10 years, and a terminal multiple of 25. That's a yield of 4% 10 years out. Maybe you don't think that is fair, but their historical yield is way above the current yield. We land at a present value of 39.15 euros. For the best case, I've gone with a growth of 7% and a terminal multiple of 28, a yield of 3.57% 10 years out. We land at a present value of 48.96 euros, about where we are today then. For the worst case, I've gone for a 2% growth. This could be higher a year or two, followed by a cut and then some growth. Terminal multiple of 20, so a yield of 5% 10 years out. Nothing out of the ordinary. We land at a present value of 27.47 euros. For the mixed valuation, I've gone with a probability of 50% for normal case, 30% for best case, and 20% for the worst case. We land at a fair price of 39.76 euros or 35.78 euros with a 10% margin of safety. Compare that to the current price of over 52 euros. If we check the ratios, they are all red. Above 1 is overvalued, under 1 is undervalued, and the cell turns green. The more above or below, the more over or undervalued. If we change the discount rate, our required return, we can see the best case is undervalued for a 7% return annually, and that is also with a 7% growth of the dividend. The other valuations are closer to 1. So, if we bought today, we could expect around a 7% return annually, based on the numbers used today. Anything can happen. They could keep climbing without raising the dividend. So last year, I used the same growth numbers and multiples. The only difference was a slightly less bullish mixed valuation, going 60-20-20. Back then, we arrived at a fair price of 37.20 euros or 33.48 euros with a 10% margin of safety. So, what's the conclusion? Is VDIV bad? Heck no. It all comes down to valuation. Remember that 3.16% yield is pre-tax. With a 15% withholding tax, that's around 2.68%. Yikes. I really like the ETF, but I can't justify buying it at these levels. Maybe someday in the future they can come down in price and I can start a position. I like their strategy and they have a great track record. As always, dollar cost average into VDIV should be fine. You buy high and low and get an okay price. For me, I'm still watching it and waiting for a better opportunity. I want to know what you think about VDIV. I know some of you hold it, so let me know in the comments. Thanks for watching and I will see you guys in the next one. Until then, stay smart, stay patient and keep stacking those dividends. Ha det gött!